Thank you for joining us for another episode of the Dealmaker Series. Today, I'm joined by founder and CEO of Skytale Group, Ben Hernandez. Ben, thank you for joining us today. Tell us a little bit about yourself and tell us about Skytale.
Thank you for having me, James. Looking forward to today and our discussion. A little bit about Skytale. We're an investment banking and management consulting firm focused in the healthcare and consumer spaces. On the consulting side, we typically help either founder-owned businesses grow and scale, or we help private equity groups or their platforms with very specific needs. And then I think investment banking is fairly self-explanatory. We take businesses to market, represent them, typically to sell them. We can do buy side work and also capital raising. My background, a little bit about myself, is in finance, did investment banking out of school. Post MBA, worked at a HBK, a hedge fund actually based out of here in Dallas, and then went and led a consulting group. And while there, that's where I got the idea to found Skytale.
Awesome. I love the niche focus too. It's not entirely industry agnostic like a lot of people like to say. As a marketer, I appreciate that. So let's get right to it then. Let's talk about some of the deal flow that you're seeing. Is that increasing, decreasing, or flat, or what are you seeing as far as deal flow?
Yeah, I would say that deal flow from a macro perspective, if you're looking at the United States in general, it's fairly consistent with the latter half of 2025. And I think that's a positive. What I mean by that is, if you compare it to coming out of COVID levels, it's not quite there yet. However, if you compare it to 2024, which was not a great year for M&A, then it is absolutely significantly better and certainly going as well as the latter half of 2025. So what we're seeing there is, from a deal flow, from a numbers perspective, I think that's relatively flat compared to 25, but the valuations are extremely good. And that's being driven by a lot of large deals. Now, if you look at it from our perspective in the healthcare space and the lower middle to middle markets, deal flow is fairly consistent. A lot of founders interested in going to market. A lot of platforms in the middle market are looking to move in some of the spaces that we're playing in. So it's actually a pretty exciting year for us so far.
Very good. Yeah, it's definitely good to hear that. And I know a lot of folks were anticipating 2026 being better than 25 and 24. So hopefully that'll actually come to fruition. Just entering Q2 at the time of this discussion. So hopefully that'll keep trending upward. What about deal structures? Is there any kind of deal structure you're seeing more frequently now?
Yeah, it's fairly consistent with prior years, especially in the space that we play in. I think it's important to note we're healthcare focused, as we mentioned. And in those spaces, it's people driven businesses, right? So it's buyers coming in to acquire, whether it's a single location or multi location group that's founder owned. So what we see in that is, significant rollover equity to create that nice alignment. So what buyers want to know is, if I'm paying a really healthy valuation and multiple for this organization that is founder owned and led, I want to be sure that that continues. And how do you, as best you can, ensure that those cash flows continue? They'll ask the owner to stay on, typically call it 3 to 5 years, depending on which healthcare subsector we're talking about here. And then we're typically seeing anywhere from 20 to 40% of rollover equity. So that's, the rest of it being cash at close. And I use that loosely. You can have other things in there within a deal structure. And then for the ones that are growing nicely, one of the things that we're seeing in a positive way is we're seeing earnouts happen. So if your company's growing at a nice clip, that's another really nice way for a buyer to align with a seller, which is, if this company keeps growing at a certain clip, then there's additional upside in the way of an earnout for you over the next 1 or 2 years, typically. So that's typically what we're seeing in a deal structure perspective right now.
Yeah, one of the themes I noticed from last year was that from 23, 22, 3, and 4, rollovers had kind of increased from maybe 15% to more that 20 to 30%. And I heard you just mention 20 to 40. And so I was going to ask about that. So you already answered that question, but I'm curious as far as the earnout side. I mean, are you seeing any changes there in particular?
No, those have been fairly consistent. One of the things that we like to say, there are good earnouts and earnouts that we don't love. There are earnouts that are, if you continue, like part of an actual deal valuation to get you to an actual valuation is an earnout. We don't love those. We like the more upside earnouts. So what we're seeing there is, and I should back up a little bit. There's a lot more stringency around when we're going through diligence. So the business maybe 3 years ago, in some of the spaces that we played in, if we had a business, we took it to market, it was probably going to trade regardless of how good of a business it was, right? Within reason, of course. I'm exaggerating
Right.
only a little bit. But right now, we're very careful in the mandates that we take on. They have to be very good businesses because diligence is just getting very stringent. So things are trading, but diligence is very stringent, especially around providers right now in the healthcare space. Depending on what subsector you're talking about, we're seeing some provider shortages. We're seeing a significant increase in payroll in some subsectors. So buyers really want to make sure that from a retention perspective that they're there. And so, that's changed a lot. And what that's done is, if you do have a business that's very good, then we're seeing significant upside in some of those earnouts. Meaning, if you're able to continue at this rate, the buyer's going to congratulate you for that. Typically, the earnout is over 1 and 2 years, 2-year earnouts. We like them to be on revenue growth, not EBITDA growth, because you can play around with the math a little bit when it comes to profitability, but revenue is a little bit more straightforward. So we're seeing a lot of that for good businesses being congratulated for performing well.
Yeah, that was a recurring theme I picked up on as well last year is pretty much only top tier firms are getting sold, right? And everything else is kind of getting ignored, but there is still a lot of activity in the market just for those that are killing it. So that's for sure the consensus, I think. What about industries or sectors? What industries are you finding most active right now?
Yeah. So, from a macro perspective, I think the industry number one that I keep reading about is, technology and AI. That's right now the number one sector this quarter. And I think even going to the latter half of 25. So when I mention that, I'd say, anything around AI, data and analytics, cybersecurity is tremendously popular right now. I'd say that's the number one. Number two, fortunately for us, is, healthcare and life sciences. And then if I can double click in that a little bit, within healthcare, the spaces that we happen to play in are very popular. Those spaces being, for us, aesthetics is an example. That's cash pay, right? So you don't have that reimbursement risk. You have, from a regulatory compliance perspective, a little bit difference, because if you're not taking insurance, that takes a lot of that pen stroke risk away as well on the reimbursement side. And certainly if you're taking government type pay as well, that gets even more stringent. So, medical aesthetics, which we define as med spa, plastic surgery, cosmetic dermatology, very popular from a consumer perspective, a patient perspective. You're seeing that demand drive up those markets. So, the expected CAGR on that from some reports is double digits over the next decade. As low as we've seen it grow is about 5%. So those are pretty high growth. The other one I should mention right now that's pretty popular is precision healthcare. And by that, I mean anything wellness, longevity, functional medicine. If you start thinking about HSAs, things like that, right? From a healthcare perspective, a lot of people are now paying cash for their healthcare. Concierge medicine is popular. A lot of the younger generations are asking the question of, how do you hack my health? Which plays really well into wellness, longevity. And that kind of gets a little bit into lab testing. That's a pretty popular space because what those companies are doing is instead of, your primary physician maybe tests you once a year, right? These are being
Mhm.
tested on in some cases every quarter. So that's an up and coming one that we're spending quite a bit of time in within healthcare. So those are some examples of exciting spaces for us right now.
Yeah, it sounds like it. Those are some really good insights. And for those watching, a fun fact: 80% or roughly 80% of the life science industry is here in DFW. I mean, Ben, to your point, I mean, you guys are in that space specifically, so you're in the right spot, that's for sure. So interesting. You mentioned the AI piece and healthcare. I'm curious, are you seeing a lot of AI being integrated into the healthcare space and some of the businesses that you're dealing with?
We are, yes. Right now, it's primarily being implemented more on the operational side from a customer service perspective. If you call a practice and they don't pick up, there's some really interesting data that you, James, are going to call another one and they're going to lose out on you. So there's a lot of interesting AI that will be sure to pick up. We'll be sure to email you right back. That we're seeing some great help with new patient and patient retention numbers. That's being very popular. Anything around the operational side to make sure that patients are being followed up on, that they're
Yeah.
touching base with you before your appointment. That right now is already happening. I think a lot of the things that we're looking out for, and this gets into a lot of legal things as well. So a lot of this is we don't know what's going to happen. But if you look at it, there's some data out there that AI can now diagnose you as well or better than some of the best doctors in the United States. So that is
Yeah.
going to turn into something. There's a lot of data out there that, if it's surgery, for example, how precise some of this can be could potentially move into there. I think we're a little bit early on that, but it's something that we're keeping an eye on. But yes, right now it's being implemented a lot on the ops side and the customer patient service experience side.
Yeah, it's very, very exciting stuff, very exciting times. Let's shift to the economic side. What sort of economic forces are currently impacting deals?
Yeah, so I think right now things are quote unquote positive, meaning if you go back even 1 year and maybe a year and a couple months, a lot of folks, a lot of creditors were unsure and buyers as to okay, what does tariffs really mean? From an economic perspective, what's that going to do? So you saw a little bit of a pause in the first quarter or so of 2025. Now that uncertainty's gone a little bit, meaning good or bad. If I, as a creditor or buyer or investor, know how to model out something, I at least know what I'm willing to pay for something. You're taking that uncertainty away. So, right now, I think, rates have for now plateaued, if you will. So, I think that's a big positive for the for our space specifically. Obviously, there's some geopolitical questions that are happening right now, but I think overall, from an economic perspective, the economy's healthy. A lot of the numbers coming out are relatively healthy. Interest rates, I think, have stabilized and, are expected to lower this year a little bit. So I think a lot of those question marks have been answered and folks are fairly comfortable right now, whether it's a credit facility lending or whether it's a buyer, going into the M&A market. We're seeing some really positive things there. So everything's pretty positive right now from that perspective, from the unknowns being answered.
Yeah, that seems to be the feeling as well. And hopefully that too. It's like hopefully that'll continue. Hopefully it'll continue to be positive and maybe even improve.
Mhm.
So all right, let's look into the crystal ball. Let's look into the future here a little bit. What do you see coming next for the M&A environment?
Yeah, so I think as we look at 26, what we were all thinking, January of 26, and compared to now, I think most of those things still remain true. Meaning, we expected 26 to be not a blockbuster year, but a solid year, kind of continuing to build on 25, and certainly better than 24. So as we look at 26, I would expect the same to continue. I think from a macro perspective, deal value is going to continue to go up as it has been. We're seeing some record level numbers actually in deal value. I mentioned it earlier, James, but it's important to bifurcate that. That deal value is on the very, very large deals, which I actually think is a good thing because a lot of private equity groups needed to trade some of their large platforms. So I think that that's positive. Deal count, I will say, I think crystal ball, I think at the end of 26, we're going to say it's a little bit softer than expected. The overall dollars are really happening at the top at those macro, large deals. Um, but, I think a lot of the smaller deals haven't been as robust as we would expect. But overall, I expect 26 to continue its strong trajectory. I think, in healthcare, deal value, same thing, has risen significantly. I think a lot of the groups that are coming to market in the middle market are going to have success. I think the last couple of years, the ones that did not trade, this is important to note, the ones that did not trade a couple years ago, and some of the, like dental's an example, for example, the feedback was you're stacking EBITDA. You need to go back and focus on operational efficiency. I think a lot of these groups have done that and they're in market right now. And from what I'm hearing, I think we're going to have some positive results, which really for our space is fantastic because all of that flows downward. So I think values are going to continue to hold. So I think the other piece to mention to maybe wrap a bow on it is I do think that good businesses are going to trade well in these sectors, but I think it's very important for when you go to market to really have a good business that's going to trade well because there is in a lot of our lower middle market space, there's a little bit of scale scarcity for good businesses. And if you can meet that demand, I think you'll get really, really good value because the valuations are absolutely there.
Yep. Yep. I've seen some of that myself. Fantastic insights. For those of you watching, I'm sure you're going to find a lot of use out of this. A lot of great insights. And um, Ben, I think you're on point with the rest of the year. I think we'll continue to see higher valuations as well. Maybe a little bit softer on the count than people were expecting. Fabulous stuff. I appreciate your time, your insights. Ben Hernandez at Skytale Group. Thank you so much.
Thank you so much for having me, James. Appreciate your time.